Hi everyone, my name is Jeremy and welcome to today's episode of Market Watch. Today I'll be talking about the monthly recession tracker, basically telling us what the US market is doing. From the most recent update for the recession tracker, the key thing that is happening right now is definitely we are seeing a risk-on kind of environment coming back to the US market. So for those that haven't been following this recession tracker, it basically consists of a list of indicators. So we can actually subdivide this list of indicators into two groups, market-based data table followed by the economic-based data at the second part of the table. So all in, it consists of 17 indicators, and what we are trying to do here is actually using this indicator to kind of find out when we think that the market top is in for the US market. So right now, the reason why we are so concerned about this downturn in the US side of things is because of the economic expansion that we are currently in. So just to put things in context, we are right now in the 107th month of economic growth since 2009. And for those that haven't been following the US market, the market moves in a boom and bust kind of a cycle. And to put things in context, the average economic expansion lasts for around 16 months or so. So right now we are 107 months of economic expansion. Definitely we are in this late stage economic cycle, and we are definitely right now in the second longest economic expansion in history. So to put things into context again, the longest economic expansion was during our 1990s decade. The economic expansion lasts for around 119 months. So right now, the reason why we are so afraid of a market downturn is because of how old we are in this economic expansion. So, and that's the reason why we kind of focus so much on this recession tracker over here. So again, to highlight what's been happening for the recession tracker point of view, only one indicator out of 17 indicator has been kind of triggered for its particular threshold, and that's the VIX index that happened in part of February, where we saw the VIX index spiking more than 100% in a single day. But ultimately, since then, we have seen the VIX index actually subsiding off its high of 50 and coming back down below 20 and more. In fact, has been trading below 15 for the past 5 weeks. So all in, right now the VIX index have been kind of moving back into a more complacent environment where the greed kind of sentiment is coming back, and we believe this should bode well the equity market. And probably just to highlight one more key economic data that has been happening is something that happened first Friday of the month. So labor market data has been doing well. So unemployment rate has been falling again from a level of 3.9% to 3.8% for the month of May, and definitely that shows continued growth within the labor market. And the key threshold for the labor market right now is at 4.2% as opposed to the current level of 3.8%. So all in recession tracker perspective, economic data are still doing pretty well at their multi-decade extreme highs and lows. So all in, we are still seeing further bullishness happening within the market, which is why in the near term, for probably another 8 more months or so, we are still risk on for the equity market. Okay, so for this slide over here, we're talking about the VIX index, and this is some near-term outlook for the VIX index. So right now, what we see is the VIX index is currently stabilizing below 20, and yes, you can see over there the highlighted region on the chart at the right side. Just to highlight that the VIX index has been trading below the 15 range for the past 5 weeks or so. That movement itself is pretty suggestive of a risk-on environment that we are currently in. And in the near term, what we expect is for the VIX index to continue to trade below the 20-25 immediate ceiling as the net speculative positioning in the future side of things remain elevated. So as you can see in the chart, I've marked up the vertical lines over there. The 3 vertical lines on the left side of the chart are the points where we see extreme buying within the VIX futures. And it's usually when we have the extreme kind of a sentiment coming into an asset class, for this instance the VIX futures, whenever the crowd is over leveraged on a certain instrument, for this case long the VIX index, long squeeze is inevitable to happen, and that will cause the unwinding of the long trade. So as you can see over there, the 3 vertical lines on the chart, it actually mark the point where we see extreme selling whenever the VIX futures hit an extreme high. So subsequently, you see a strong market downturn within the VIX futures in a range of around 20 to 40%. So the most recent example, we saw the VIX futures net speculative positioning hit a high of 92,000 contracts, and as you can see over there, that's the point where suddenly the market kind of tipped lower in terms of the VIX index, and it has been trading back down below 20 for the past 5 weeks. And hence, in the near term, we expect the VIX index to continue to trade relatively calmly below the 20 range as we experience this long squeeze and as the positioning within the net speculator side of things rebalance to a more normal level. Moving on to the TED spread. Again, for those that haven't been following, TED spread basically measures the spread between the 3-month LIBOR to the 3-month Treasury yield. And just to highlight what's been happening from the TED spread perspective, a rising TED spread shows distress in the interbank level, and on the flip side, falling TED spread shows all is well in the banking side of things. So as you can see over there on the chart, April was when we suddenly got a flip of sentiment in the TED spread, whereby we kind of broke above the 36 basis point range high back then, and since then you can see TED spread spiked above to a high of 68 basis point during that short time frame of 1 month. But with the benefit of hindsight, for the past 2 months, the TED spread has been renormalizing back down to a normal level from 68 basis points to the current level of around 43 basis points. Right now, the directions to tell us that the equity market should continue to do well as the TED spread kind of fall back off its high of 63 basis points. In terms of key level to watch out for the TED spread, the 1% is the key threshold to watch based off our study. So as long as the TED spread continues to stay below the 1% level, we believe the equity market should continue with its current climb moving forward in the near term, probably for another 6 to 8 more months or so. And right now, covering the 210 spread. So this is one of the more important indicators that we like to watch a lot. So 210 spread, again, for those that don't know, basically measures the spread between the 10-year Treasury yield to the 2-year Treasury yield. And over here, I just want to highlight the recession timeline that we see based off this particular indicator. So this can be seen as a proxy to the yield curve. And how do you read this chart? It might look complicated, but just bear with me. The horizontal line at the top panel is the 0 level, and the vertical stripes on the chart shows you the recessionary period. So historically, what we see is when the 210 spread actually falls below 0 and heads into an inverted kind of environment, recession is not too far away. So on average, recession lags the inversion of yield curve by around 50 weeks or so. So right now, we don't really see current environment as a cause for concern, as the 210 spread still trades around the 40 basis point level. So again, the key threshold for the 210 spread to signal bearish market is for it to fall below 0, and we believe for that to happen, it could still easily take the market another 7 to 8 more months of further flattening before we see the 210 spread kind of invert and kind of a signal to us the recession is not too far away. But just to highlight the bottom panel over there, which is the Fed funds rate, historically what we've seen is the rate hike cycle is the reason why we see the flattening of the yield curve. So as you can see, the bottom panel mark out a few up arrows. It corresponds pretty nicely to the top panel whereby we see the flattening of the yield curve. So historically, when the Fed actually hikes its interest rate, it's inevitable that the 210 spread will flatten and ultimately invert. So right now, the Fed actually began its rate hike cycle back in December of 2015, and since then we have saw interest rate kind of rising from 0.025% to the current level of 1.75%. And as you can see, since December of 2015, the 210 spread has been flattening pretty tremendously due to the Fed rate hike cycle. Right now, we are expecting one more rate hike coming June, so that will bring the Fed funds rate to 2%. And as long as the Fed continues to stay on this rate hike cycle, the 210 spread is just a matter of time before it kind of inverts and falls into the bearish threshold. And like I mentioned again, our base case scenario still points to us another 8 more months or so of this flattening trend before we see the 210 spread invert. So hence, in the near term, for the next 8 months or so, we still expect the equity market to kind of behave in a risk-on kind of a sentiment until the 210 spread inverts. And moving on to the next indicator, one of the more important one, which is the Fed funds rate, basically the benchmark interest rate set by the Federal Reserve in the US. So as you can see over there on the chart, we have two things, the Fed funds rate shown in the orange line and the blue line in the S&P 500 index. Just to highlight again, how to view this chart is the vertical stripes are the recessionary period. And historically, you can see that the end of the rate hike cycle is usually the point where we see major crises or major recession happening. So maybe just to illustrate what I mean by that, the rate hike cycle in the housing boom period started somewhere in June of 2004, where the Fed brought its interest rate up from 1% all the way to a high of 5.25% over a time frame of around 2 years. And it's somewhere around in June of 2006 whereby the Fed kind of halted its rate hike cycle at 5.25%. And as you can see over there, that was the first red flag that the market is kind of a wobbly already. But during that period from 06 to 07, the market continued its climb. And ultimately, the thing that actually triggered the market sell-off and the market top is the moment where the Fed actually cut its interest rate down from 5.25% to 4.75%. So that move from 5.25% to 4.75% is a big move because the Fed actually cut its interest rate 50 basis points, which is not normal. Usually the Fed moves in tranches of 0.25%. So during that period, you can consider the Fed cutting interest rate twice, and that actually sparked the market sell-off during that period. So that part over there kind of a pinpoint to us the end of the equity bull market, and we saw the S&P 500 index crumbling for more than 50% during that period and signaling to us a recession. So right now we are definitely in the new era of rate hike cycle. It happened in December of 2015 where we bring interest rate up from 0.25% to the current level of 1.75%. Right now we are expecting the Fed to hike a few more times this year, probably 2 more times. And by end of this year we can expect the Fed funds rate to be at 2.25%. And moving forward in 2019, we could easily still expect 3 more rate hikes. So all in using that signaling from the Fed, as long as the Fed continues to hike its interest rate, it will signal to us that the economy is strong enough to withstand further rate hikes. But the moment to be afraid of the end of this equity bull market is when the Fed actually stop its rate hike cycle and actually cut the interest rate. So the point where they start to cut its interest rate, I think, is the end of the bubble for the current environment. And probably the moment when they cut interest rate is the time to kind of be a bit more on the risk-off side of things than the current risk-on environment. But again, like I mentioned, moving forward, we are still in this rate hike trajectory. It could still easily last for another year or so. So that's why in the near term, we are still pretty bullish on the equity market until the Fed actually paused with this rate hike cycle. Okay, so right now I'll talk about something that's more updated. So here's the small cap stocks, the Russell 2000 index. Just to emphasize this current bullish price action that's been happening. So Russell 2000 basically shows you the small cap stocks is currently outperforming the big boys. And just to highlight again what has been happening since the January high of 1618 points, we saw a huge sell-off within the market. The Russell 2000 actually fell 11%. But after that particular sharp sell-off, you have seen the Russell 2000 index actually outperforming the rest of the market, and right now actually breaking above new record high. And instead, right now we are seeing a strong rebound of around 14% of the February sell-off low. So it's with this particular kind of a breakout in the prior record high that we are seeing a lot of risk-on sentiment coming back into the riskier asset class, which is why we are pretty bullish on the big boys, ultimately to catch up with these small boys, and ultimately again retesting the prior record high that was set back in January. And right now we'll just talk about the big boy side of things. So S&P 500 index, closely watched index. So again, to emphasize the bullish price action over here, you can see a longer term price action pattern, the triple bottom of the 200-day moving average, the green line, more or less will anchor in a floor on price. And ultimately, it's with that bullish price action that we see and the most recent bullish breakout above the downtrend line for the S&P 500 index that we are pretty certain that this uptrend in the S&P 500 index has returned. And again, to follow the small cap stocks, we pretty much expect the S&P 500 index to right now head into this new wave of uptrend. And next thing for the bulls is to retest the 2,800 points resistance area, followed by 2,878 points prior record high set in January. And same thing over here for the Dow Jones Industrial Average. Pretty similar price action pattern, triple bottom of the 200-day moving average should more or less anchor in the floor for the long-term trend for the Dow Jones Industrial Average. And ultimately, again, it's with the bullish breakthrough above the downtrend line that signals to us that the long-term bulls have come back to the game. And hence, we expect this risk-on kind of a sentiment together with the recession tracker signaling further upside for the Dow Jones Industrial Average to retest the immediate resistance area at 25,774 points, followed by 26,684 points. And last but not least, the Nasdaq 100, again, bullish price action. So Nasdaq 100 is the strongest amongst the big boys. So as you can see over here, instead of seeing a triple bottom, you are seeing a double bottom formation of the 200-day moving average. That by itself is really setting in the floor for price. But again, to re-emphasize the most recent bullish breakout for the Nasdaq 100, where we saw the Nasdaq 100 breaking above its immediate range high of 7,000 points. So 7,000 points is a huge psychological round number, and we broke above that level this week. So you can see since breaking above that 7,000 psychological round number shown in the highlighted area, we saw a huge wave of buying coming back to the market, and right now we are retesting the much high of around 7,200 points. So moving forward, we believe this risk-on sentiment should stay sustained, and hence for the Nasdaq 100, we believe the bulls are right now targeting the 7,400 points psychological area, followed by 7,500 points. Hence, in summary, we believe the recession tracker continues to signal to us to stay on the risk-on side of things moving forward, despite the ongoing political scare in Italy. And until we get the further deterioration in economic data, which is not happening right now, we continue to stay bullish on the equity market, mainly for the Dow, the S&P 500 index, and the Nasdaq to retest its prior record high that was set in January. And moving forward, we expect this bullish sentiment to last for another 6 to 8 more months out until the 210 spread actually falls into the negative territory and after the yield curve actually inverts. Yep, and with this, we've come to the end of this week's Market Watch. So for more information, you can head over to stocksbnb.com for more of our reports as well as our webinar. Thank you.